Receivables represent an asset of an entity, whether it be a business or customer owed to a company. The most common type of receivable is an account receivable, where businesses account for amounts owed by customers who have previously purchased a good or service. Receivables are recorded on sale when the amount is not paid immediately. For example, if a company were to sell $2,000 worth of white goods to a consumer and they pay on credit, thus the money is not instantly paid to the business, the transaction would be recorded as follows. The company would credit sales to the amount of $2,000 as they lost that much worth of goods, whilst they debit accounts receivable for the amount of $2,000 as the consumer has not yet paid, but they recognise the revenue earned. The accounts receivable process follows in accordance with the revenue recognition principle, as they account for revenue once it has been earned, not received. Consequently, as the business accounts for receivables when the money is earned, they must similarly alter the receivables account when there are returns on goods sold. When refunding a return, the company must take into consideration the amount returned, in this case $300 worth of white goods, and thus credit that amount from their receivable accounts, so as to recognise that the money is no longer in that account. In doing this, they must then debit that $300 to sales returns and allowances to make it obvious that that's where the money has come from. This process allows the account's information to be accurate, and thus the business is complying with the GAAP principles and presenting relevant, reliable, comparable and understandable accounting information.